Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ investors, welcome to the show. It's great to have you here. In this episode, you will learn why I believe that thematic ETFs are a ripoff for retail investors. Before we get started, if you haven't already, please take a second to subscribe or follow on Apple Podcasts or Spotify. That way you'll be notified as soon as new episodes are released, and you'll be able to use this information before everyone else. Now, before I tell you why I personally believe that thematic ETFs are a ripoff, let me make sure everyone is up to speed.
Yo, baby! It's your boy, Jimmy New York, fresh out of the joint. I need to know, what's a thematic ETF?
According to entrepreneur.com, thematic ETFs allow investors to invest through a single instrument in a basket of stocks exposed to a specific theme, such as electric cars, cybersecurity, clean energy, or vegan products. The Wall Street Journal says that thematic ETFs allow investors to bet on trends and concepts, and this is becoming an increasingly popular way to invest. Thematic ETF assets in the United States grew from $28 billion at the beginning of 2020 to $104 billion by the end of 2020. And in the first month of 2021, another $15 billion poured into thematic ETFs, setting a new one-month record for inflows. With all that said, why do I think thematic ETFs are a ripoff for retail investors? My number one reason here is costs. Thematic ETFs are expensive. John Bogle said, and I quote, "In investing, you get what you don't pay for. Costs matter. So intelligent investors will use low-cost index funds to build portfolios of stocks and bonds, and they will stay the course." Now, what John Bogle described is arguably the most rational way to build wealth over your investing lifetime. And it's actually the approach to investing that Warren Buffett himself recommends. One of the reasons for this has to do with the costs. If you go with something like the Vanguard S&P 500 Index ETF, which trades with the ticker VOO, or I call it the VOO, that has an expense ratio of 0.03%. Now let's compare that to one of the most popular thematic ETFs, and that is the ARK Genomic Revolution ETF, which is operated or actively managed, I should say, by Kathy Wood and the folks at ARK Investment Management. ARKG, that's the ticker, ARKG has a expense ratio of 0.75%. But let's look at the kind of impact that those fees would have over a 40-year period. Imagine there are two investors that each have $100,000. The first puts their money in the VOO, and the second puts their money in ARKG. During this 40-year period, their money compounds uninterrupted at an average rate of 10% per year. By the end of that 40-year period, the difference in unrealized gains is pretty shocking. The investor who put their money in the VOO ends up with more than $1 million than the investor who put their money in ARKG. And the reason for this is the expense ratio. Now, I could just end the podcast right now. This could be the mic drop moment. I could spike the football. I could start beating my chest like an animal and saying that, King Kong doesn't have on me, but that would be a really great listening experience. But I don't want to just leave it at that, because I understand why people are attracted to these thematic ETFs in the first place. In fact, in 2016, when I knew far less than I know now, I invested in an ETF or a thematic ETF called BOTZ, B-O-T-Z. And at the end of that year, in 2016, I wrote down that it was one of my dumbest decisions of the year. Thankfully, I recognized this sooner than later, and I sold. I think I lost $3,000, which, thankfully I made back in other ways, but it was not something that felt good, but I learned a lesson. Why it's a dumb idea, though, and this is something that I now understand much better than I ever did, and hopefully I can help you understand it, it's that investing doesn't work like this. Remember, stocks are pieces of businesses. We might as well just say that stocks are businesses. So you can believe that the future of, let's say, genomics or biotech is bright, and that this is going to be a great space that just creates all sorts of value for society, but you still have to pick the right businesses. We did an episode about Warren Buffett's speech at the Sun Valley Conference in 1999, and I highly recommend you go back and listen to that to get a better sense of the historical context here. But let me share with you one part in particular from that speech that was then transcribed and printed in Fortune magazine. Again, this is in 1999. Warren Buffett said, and I quote, "The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company, and above all, the durability of that advantage. The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors. So if you really knew something about one of these themes or categories, you wouldn't want to pay a high expense ratio to own a basket of companies that are all exposed to this theme or these categories. You would pick the winners. There's only going to be a few companies that win. And I'll use another example that's borrowed from that Warren Buffett keynote speech. It's about the automotive industry. In the first quarter of the last century, there were nearly, I think it was 2,000 different automobile makers. So there were 2,000 different companies that were making cars because cars were seen as the future. That's where the money was going to be. It would have made sense to bet on a basket of stocks that has, let's say, 60 different companies that are exposed to the autos. But actually, if we fast forward, only 2 or 3 made it. And if we go back to 2008, there were 3 companies left, and 2 of them needed to be bailed out by the government. So to pick the winners, not only the odds are against you, but it's proven historically to be nearly impossible to do, and it's cost investors a lot of money, investors who thought they could do it. Now, it might work in the short term when we're in a speculative frenzy and, valuations are extremely high, but when things ultimately come back to reality, when the voting machine becomes a weighing machine, there's only a few companies that are really going to generate returns, meaningful returns for you as an investor. So owning a basket of all these different companies within these themes or categories or sectors, it just doesn't add up. It doesn't align with the first principles of investing. Warren Buffett noted, and I quote, "There were 2,000 auto companies, the most important invention probably of the first half of the 20th century. It had an enormous impact on people's lives. If you had seen at the time of the first cars how this country would develop a connection with autos, you would have said, 'This is the place I must be.' But of the 2,000 companies, as of a few years ago, only 3 car companies survived. And at one time or another, all 3 were selling for less than book value, which is the amount of money that had been put into the companies and left there. So autos had an enormous impact on America, but in the opposite direction on investors." And what Warren Buffett is saying here is that just because something has the potential to change the lives of, everyone in the country, that doesn't mean that the businesses that are, part of this change or part of this revolution or innovation, that doesn't mean they're sound investments. Because remember, stocks are pieces of businesses, and those businesses can be quantified, can be evaluated using a set of criteria that has nothing to do with, what kind of impact they're going to have or how much they change the world. Remember what Warren Buffett said, and we quoted this in a previous episode about how Warren Buffett picks winning stocks. He noted that you're looking for a business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Now, if we look at ARCG, even just the top 10 holdings in that basket, some of those companies are in direct competition with one another. So not all of them are going to be winners. So if you're investing, or you believe rather, in the future of genomics or biotech, if you're unable to say with any certainty what companies are going to have earnings that grow and continue to grow materially higher over the next 5, 10, and 20 years, then you should just do broad-based indexing. Invest in the VU as an example, and that's not financial advice. I'm just using that as an example. This whole notion of buying a basket of stocks that are all exposed to one theme, sector, trend, concept, it sounds great, but it's not great for investors. It's not proven to work, it doesn't make sense, and it doesn't align with the first principles. This has been Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.